Well, sports is a bright spot for Disney, but linear trends from the House of Mouse, as well as Comcast, Paramount, and Warner Brothers Discovery, are mirroring the declines we've been noting from the European broadcasters as well. Also, the numbers are rolling in from our global markets for our advertising forecast, and the trends point to a more sanguine outlook than expected, but there are some warning signs lurking under the surface. You're listening to the Media Intelligence Podcast from WPP Media. I'm Kate Scott Dawkins with Jeff Foster and Nidhi Shah from the Business Intelligence team, and each week we unpack the biggest stories in media and marketing and why they matter for brands. So I guess the first thing is just to check on how everyone's doing, because every time we get around to a earnings season that overlaps with our forecast development season, it gets to be a little crazy. So how's everyone doing?
Yeah, hanging in there. I mean, I have not taken a medical board or a bar exam, but it feels like what it would be like leading up to this.
Yeah. Nidhi, how about you?
Yeah, pretty much the same. I was down with a bit of a cold last week, but back in the game this week, and it's been great. You get a lot of insights as well during this reporting period, which is always fascinating.
It's just like to your point of studying for something. It's like how much information about the advertising industry, the economy, not just in the market we live in, right? But for me, I'm looking after the Asia Pacific markets. And so you're paying attention to typhoons and their impact and various bank rate decisions in all of these markets. And it's about how much you can hold all of that in your head at one time, as well as, whoever just reported that day or the week before. So we have been on a bit of a hiatus the last couple of weeks. So it was just to sort of deal with the volume of inflow and work related to producing the December forecast. So we're back. We're going to go over some of the earnings that we've missed out the last couple of weeks. And then we'll be back again next week, maybe to do some more foreshadowing of what we're going to see in the report before we take the Thanksgiving week off on holiday as well. Well, holiday from the podcast, not necessarily a holiday from working. All right, so let's start with a couple of the European reporters.
Yes, and I think it just continues with the softer kind of outlook we've been seeing in the traditional media space, particularly between broadcasters and also now out of home. And it just shows how much sports is having an impact on traditional media players and that growth, right? We're seeing more signs of consolidation. The recent talks of Comcast bidding for ITV's media and entertainment business, which includes obviously the broadcast channels as well as the streaming ITVX service. So it's just clear signal as to that will probably likely continue. As well, I think, companies, need scale. I think that's something that will be more important now more than ever. You're just not competing with media tech giants, but also AI companies that are now coming into play, or the rising costs of content production, streaming technology and developing those in the midst of linear declines. And that's what the results have been showing us for the first 9 months. ITV reported about a 5% decline in total advertising revenue. ProSieben Sat.1 reported about 6% similar declines. And both companies really expecting a decline of mid-single digit for the remainder of this year, for the full year.
And one thing I was just thinking about, because we were also talking about Warner Brothers Discovery before we hit record today, is that it's an interesting difference in how they're thinking about splitting up the assets, right? So ITV is keeping its studio business, right? That they can be a seller of content to as many different players as possible, selling off the media business and the streaming business together, right? Versus Warner Brothers Discovery now, how they've talked about if they were just to do it themselves, splitting up the business would have been studios and streaming together separate from the TV business. I don't know. Do we like either one of those better or worse? The whole Warner Brothers family of assets, I feel like it's just cursed at this point. None of the big acquisitions have really delivered the kind of value to company and shareholders that was promised at the outset. So I'm still not sure about where that one's gonna go. But it is a different approach to that business. I think the ITV version maybe makes somewhat more sense to me, right? Like having the production separate, selling to all the different entities, and then having all the customer touch points, whether it's via streaming or linear channels or whatever else, sit in another company. That feels like a cleaner break than trying to cleave off streaming and keep it with the studio business. Jeff, what do you think?
Yeah, no, I agree. I think, it's also interesting. There were some reports, but, unconfirmed that other people were kicking the tires on ITV Studios, which does have, as you said, a lot of value, especially with formats specializing in, reality shows, which are generally cheaper to produce and easier to replicate in different markets around the world. So I don't know. I'm just think the ITV story may not be fully complete yet, but that's just my speculation.
Yeah. Anything else from that side of the pond?
Yeah, we had out of home as well, similar kind of softness, mainly from the tough comparables of the Olympics last year as well as the Euros. JCDecaux reported about 0.9% decline in organic revenue growth in the third quarter, with digital continuing to grow. Same story with Stroa. Out of home grew about 1.4% for the first 9 months of this year. Digital out of home in kind of double digits. So I think it's a similar story for most of the traditional media owners, where digital is continuing to grow, but not really fully offsetting the declines in the kind of traditional media.
You noted about the transport growth too when we were speaking earlier, which is definitely something I think we've seen and heard as a global trend when we've been looking at all the different markets for out of home, just how important transit and transport has been to growth in a number of markets. I think it's broader than just commuter patterns returning to more normalcy after COVID. I think there's definitely an element of the airport travel side of things as well. And we had pretty good results from folks like Airbnb, Expedia, and Bookings as well on travel nights, flights. So, and a mix, I think, between consumer and business bookings as well. So, despite the sort of unease about decoupling and tariffs and whatever else, but I think travel as a spending category, maybe as being service and therefore free of tariffs in a sense, is definitely helping, and maybe not as much US traffic. There was also a note the other day, I forget which paper, I'm sorry, but about the crossings from Canada to the US being down. But I think domestic travel in the US and then travel elsewhere from places like Europe and across APAC is definitely seeing a rebound and helping that out of home category for sure.
No, 100%. And transport was the only category really growing in the third quarter of JCDecaux's results, alongside, obviously the digital formats benefiting from increasing programmatic as well. Transport, travel, that sector as a whole really holding up, even in the earnings we're seeing so far.
Are either of you traveling for the holidays? They're Jeff Thanksgiving or because you've had your holidays for Diwali already, and I think most of your family's local, right, Nidhi? So maybe not, but maybe traveling for sun then.
I've had 3 holidays this year, so I don't think I could get away with another one at the Christmas peak prices.
So you've been keeping up the travel industry single-handedly.
Yeah, no, I'm just going to be relatively local-ish, which is actually, I think, a blessing in disguise, seeing what's going on here with all the air travel in the U.S. I'm okay sitting this year out.
I got back from London before the shutdown, and then I think the next trip, all work trips, by the way, not for pleasure, but the next one, I think hopefully the air traffic control and TSA and everything else is back to normal before that one later in the year, and then looking forward to CES in January. Not necessarily to Vegas, but since that's where CES is, I'm looking forward to CES. I think that'll be a good time as well. I'm excited to see all the robotics stuff and more flying cars, some reality checks for the myth of flying cars, maybe. What else do we have? We've got Amazon was another one that reported during our sort of 2-week break. Pretty healthy numbers from them, especially around cloud and advertising. Jeff, do you want to take us through some of the highlights there?
Sure. So looking at revenue was 180.2 billion, so up 12% year over year, excluding any foreign exchange. So it comes in 40 basis points above the high end of guidance. And then looking at AWS revenue was up 3 points from the second quarter to 20% year over year, excluding foreign exchange. reacceleration AWS growth was driven by demand for cloud and AI workloads as Amazon's backlog grew to $200 billion, up 22%. And that's not accounting for deals announced in October, which
Yeah.
together was more than the total deal volume at Oliver. So, yeah, I mean, it was just, I would say, a very, I don't even know the words to describe it. Healthy, strong, all of the
Yeah.
above.
That call out was in particular, I noted from one of our analyst friends who was talking about the deal volume and the backlog. So that's a big one. I want to make sure we called that one out for sure. Still expecting to make significant CapEx investments to support AI demand, plus advertising in particular up as well. Again, double digits and accounting for quite a healthy share of overall income and profit as well, right? I think that's the punching above its weight for sure around versus like the low margin retail business. The other couple other interesting pieces for Amazon. I mean, again, it's hard to keep up with all the news announcements that are happening at pace across all these different companies. There was one from the Unboxed event that advertising on Prime Video now reaches 315 monthly viewers, average monthly viewers from 200 million in April 2024. So definitely scaling that. And that's something that we've seen again as we're looking at all our international markets and we're talking to them about streaming TV and why we're seeing certain growth rates. I think markets where they're in future years expecting potentially Netflix or Amazon to launch is dictating where they're showing growth and declines, more or less rapidly across streaming TV and linear TV. So these newer companies are definitely having an impact on those industry totals, something for marketers to be aware of in those international emerging markets, maybe where they haven't launched yet, to be looking at that and those timelines as something to keep an eye on for future. So that 315 compares to Netflix, which recently announced 190 million monthly viewers on ad tiers. They did give us a little bit more detail than Amazon and how that's being measured. They're looking at a certain amount of time, right, Jeff? And then like
Yeah.
increase extrapolating to who else is in the room as well.
Yeah, I believe it was like a minimum of 1 minute view time. So yeah, it's definitely, a little different than the old traditional linear television metrics. So it's very hard to kind of, like you said, extrapolate what the, an apples to apples type of comparison is. And, going back to the Amazon point too, is what we were talking about yesterday. And of course, Amazon now having the NBA, as part of their content and providing all the advertising that comes along with that, I would expect to see, those growth numbers continue to go up, especially in the near term.
Yeah, Netflix is to NFL games,
Yep.
Amazon with NBA, and really we're going to see that same story play out in international markets too. It's where these sports rights go, so goes the advertising.
So it seems, as we'll see when we get into the media owners reporting a little bit later.
Yeah, for sure. And I think, combining that reach and the content inventory piece alongside things like AWS and the data it has for businesses, the growth of its DSP, especially in starting to offer more than just the sponsored listings on its site, alongside things like Rufus, their AI commerce bot. So you can start to see that picture coming together for Amazon a little bit. Although, again, still without their own foundational model, but I think there've also been announcements about investment in other AI companies for them. So yeah, more to watch there, but certainly interesting to see where that's headed. And our producer has left us a note saying that Rufus, the AI shopping assistant, has been used by 250 million active customers this year. So there's some big numbers that we're starting to get to for these companies.
Yeah, and we've been talking about it a lot, but it's just when you look at Amazon's infrastructure and ecosystem, it offers a very compelling choice for advertisers.
Yeah. Well, alongside Google too, right?
Yep.
There was a great article in, I think it was Bloomberg this morning, saying that, Sundar Pichai is the wartime CEO Google needs and how they've really gone from strength to strength. I think after admittedly getting a little bit caught out by the launch of ChatGPT from OpenAI and the ability to, again, combine all of these assets and capabilities, like we were talking about with Amazon across Mail and YouTube and Maps and Waymo even, right? That real world robotics and knowledge infrastructure starts to look really interesting. All right. Well, from big tech flexing its reach to a streamer providing free TV, Tubi is definitely a big piece of the story for Fox. But what else do we hear from Fox?
Yeah, so Tubi was definitely the most interesting and the biggest part of the earnings, I would say. When looking at the top line, revenue at Fox rose about 4.9% to a little over 3.7 billion, which beat Wall Street expectations. Advertising revenues, I would say probably of all the legacy media companies, were the strongest, up 6%. With Tubi being a big contributor, and some interesting commentary from Lachlan Murdoch, the CD, that we are enjoying the most robust advertising market we have seen for some time. Well, definitely different commentary than what we've been hearing from other legacy media companies. And then he did provide a little bit more color, saying higher prices and higher ratings help offset lower political advertising revenues. Because it's also interesting to note that this is up against a very tough comp quarter for Fox with all the political advertising a year
Yeah.
ago. So when you see them increasing 6% versus a tough comp quarter, yeah, it was pretty impressive, I would say. And then looking at the cable network segment, which is primarily Fox News and Fox Sports 1, of course, advertising revenues were up 7%, higher pricing, which we've been hearing about, especially on the news side. And then going back to that television segment, which is an interesting one because it includes broadcast, local, and Tubi. But
Hmm.
advertising revenues increased 6%, and again, primarily led by digital growth by Tubi and higher sports pricing, which offset the political advertising.
Yeah.
And then just a little bit more color on Tubi was 27% revenue growth, driven by an 18% increase in total view time. And Tubi reached profitability for the first time this past quarter, which is a little bit ahead of schedule from what they had originally said.
Yeah. They originally, what's it, like end of 26 or
And
something, I thought.
26, yeah,
Yeah.
yeah.
It's a
So,
good salesman who
yeah, you
under promises and
yeah,
over delivers or whatever. Yeah.
exactly. It seems to be a good strategy. The stock has been doing quite well, and then they did mention that Tubi is expected to be a meaningful contributor to EBITDA in the medium term, and they expect those margins to be in the 20 to 25% range, which is pretty good margins.
Yeah, well, they're going to get helped by whatever they announced this week, which was that users are going to be asked to start logging in to view Tubi. So rather than just turning on the channel and viewing anonymously, even if it's free, you need to provide an email and log in, and that should help them with their advertising and addressability in terms of
Yeah,
being able to personalize those messages a bit more.
exactly. As soon as I saw that announcement, you're like, I think we're going to see a little bit more advanced targeting coming up soon, and a rollout of probably that strategy. It all kind of makes sense.
Now, 18% increase in total view time. I mean, we're not seeing people spending a bunch more time on TV in general. So that says you're either taking share or maybe, I don't know, who knows, like less active viewing time. Again, because it's free, it's just on in the background the same way people
Yeah,
used to leave sort of broadcast or cable TV on for the day. And we would say the same thing about YouTube. So this is not, or any other channel. You just want to read behind those numbers a little bit.
exactly. Because Tubi has very specific channels, or like you said, very similar to like an old school syndication where you might just leave an afternoon of Friends on in the background, or a favorite classic TV show.
I was gonna say, yeah, their audience, maybe it's more like Gunsmoke, like an entire Gunsmoke channel or something. Yeah.
Gunsmoke, or one of those more classic TV shows from the 60s or 70s or so. So a lot of that might be contributing into that that viewership number.
All right. Well, moving on to streaming moves and Comcast. Peacock is quietly gobbling up more of NBC's upfront dollars, so more commitments to Peacock as a part of the upfronts, even while broadband growth, we saw some losses there in terms of the video subscribers. So let's dig into Comcast quickly as well.
Yeah, again, for Comcast, total revenue was down 3% in the quarter, and looking at the NBCU revenue was 6.6 billion, which was down almost 20%. Now, of course, this comes with the big caveat of Olympics and political advertising, of course. So when stripping out the Olympics, domestic advertising was up about 2.63% range. So not terrible given the
Yeah.
market, but all things considered, very, very strong. And then, of course, course, looking at Peacock, because that gets a lot of attention, it has 41 million subscribers, essentially flat for the last 3 quarters. Reported losses were 217 million for the quarter, which was an improvement of the 436 million in losses the previous quarter. So on the path to profitability, or at least break even, which is an encouraging sign. And then, of course, the film studio, which had a nice summer run with Jurassic World Rebirth and theme parks revenue, which did pretty well too.
Yeah, the kids are looking for. We haven't watched Rebirth yet, but it's on our list. We just actually watched Lord of the Rings. We're almost all the way through the first Lord.
Oh,
I mean, that was like a 3-hour time commitment for Lord of
just
the
the
Rings.
first,
So
just the
just the
first
first
one.
one.
Yeah, yeah, yeah. Especially if
Uh,
you watch the director's cut, then it's even longer.
yeah, no, this is standard
Yeah.
3-hour Fellowship of the Rings. But yeah, it's nice that they're getting old enough where we can watch some good classic.
Still holds up.
Yes, for sure.
And just one other note on the NBCU Comcast side, there was some of the M&A speculation, which they did comment that things are more viable than some of the public commentary that's out there. So we, of course, know that everybody has been kicking the tires on Warner Brothers Discovery. So I think you can probably read into that there is some interest there as well.
Let's get into the Paramount and Warner Brothers earnings. Paramount, this is their first earnings as a combined entity. Paramount Skydance, with advertising down double digits, 11%. So not the best way to introduce yourself to the market. But what else can we learn from their earnings?
So, like you said, not maybe a little bit of a rocky start as the newest version or iteration of Paramount Skydance. I think some of the big takeaways, at least when I was reading through the transcripts and listening to the earnings, David Ellison did acknowledge the MA options. He didn't specifically address anything. Interesting to say that he kind of used what Netflix has been saying for seemingly forever, that we looked at this as a buy versus build, and we absolutely have the ability to build, but didn't exactly shoot down speculation of Warner Brothers Discovery, which we know they've made, I think, 3 offers to Warner Brothers Discovery
Yeah,
at
at
this
that point. I
point.
mean,
Yeah,
I was going to say, you don't want to sound desperate like you need it,
right.
but I think they've already that ship has sailed a little bit, but that's okay.
Right, right. And I think some of the other interesting things to pull out from the earnings call was that DTC advertising was 479 million, which was down about 5.5%. So yeah, a little different than when looking at like Tubi, for example. But
Yeah, although
interesting to see that comparison.
Paramount Plus was up, so that's mostly a
Yeah,
Pluto TV weakness. We're
exactly.
thinking, which again, that Pluto versus Tubi is an interesting comparison. Then,
Yeah, and they did call out weaknesses in that on the Pluto side. They didn't give a lot of specifics, but they did say that DTC overall achieved profitability with adjusted operating income, so before depreciation and amortization, of 235. So there's a lot of words in there to sort of parse.
yeah,
But they did say they expect DTC to be profitable in 2025 with growth and profitability in 2026. And of course, the recent announcement as well about Paramount Plus price increase
yeah,
starting in January here in the U.S. The ad-supported plans will go up $1 to $8.99 a month, and the ad-free goes up $1 as well to $13.99 a month. And Paramount Plus also raised prices in 2023 and in last June, and it recently raised prices in Canada and Australia. So I think we're seeing a little bit of a theme here.
yeah. Well, it's what the market will bear, and they're just testing that. I think as long as they can maintain members or users and grow that top line revenue number, they're going to do that to support the rest of the business.
Exactly. And then one final piece is I guess you'll get a little bit more for your money, as they said that they're going to be growing theatrical output to at least 15 films per year. So I guess if you're spending a little bit more on your DTC subscription, you might have more movies to see. And that's based off of 9 films are slated to release in this current year in 2025. So it's a nice increase from that.
Is that just coming from the combination of Skydance and Paramount, or is that actually that much more than they would have? I'm just
Yeah, I mean
curious.
it's a little hard to
Yeah,
to
parse.
peer
Okay.
to kind of put it together, since Skydance does a lot of financing and was partnered with Paramount. So a lot
Right.
of these
Okay.
might have
We'll
been
do some more digging on that maybe
yeah.
after this year, next year.
Exactly.
All right. Well, and the I was gonna say the belle of the ball. It's not really the like target of all these acquisition conversations. Warner Brothers also reported total revenue down 6%, also in constant currency to 9 billion. Advertising revenue down 16.3% to 1.4 billion, or down about 17% in constant currency. And really, global linear networks advertising down 21% in constant currency. So quite a weak spot for them. They did have the Olympics in Europe, the rights to that in the same quarter last year. So, that's some of it, but that's still definitely a hefty decline coming off of last year, despite subs being up a little bit, 128, up from about 126 last quarter. From them, I think not really much other than they're reviewing all the strategic options, although we did get a timing update that we'll hear something by Christmas as to what they're going to decide to do.
Yeah, so I think that was probably one of the biggest things that came out of their earnings was there's a little bit more of a definitive timeline that some sort of decision will be made around Christmas. Now, whether that decision is an actual sale or just we're going to move ahead with our split, or we're still going to entertain offers. So we'll see. But this could be going on for the definitely for the near term future.
Yeah, I mean, as an advertiser, and we can touch on Disney too, right? But as an advertiser, as you're looking at the landscape shaking up, it has to still be the content and the investment in the content primarily that is driving investment decisions, right? So if being more scaled allows them to compete for IP and films or shows, better against their competitors, then that's likely good, right? And leads to better advertising revenues. If they are able to bid on sports that bring in viewers, that's likely
Mhm.
good. But I'm just trying to also think about the advertiser lens, the client lens for this is how they should be thinking about this marketplace and what's happening right now. Obviously, all these companies have to navigate this transition by continuing to support the pieces of the
Mhm.
business that are working and driving revenue today, now, and still have viewers, while investing in the streaming businesses that are the future, right? Of how we're going to how people are going to connect with content going forward.
Yeah, I mean, we're just seeing this just in these recent earnings, just all the big variances and on the streaming business, with some being down, some being flat, some being up a little bit. So yeah, it's definitely going to be an uneven rise, at least again in the short term.
All right. Well, maybe we can touch on Disney in more detail next time as well. Is there anything else from this week we want to talk about? Otherwise, for next week, I think we're looking forward to a slowdown in earnings. There are a few stragglers at least, but not the kind of volume that we've been dealing with the last couple of weeks. And we will be finalizing our forecast numbers ahead of then actually writing the full report. So it'll be exciting to see how all that flows through. We're going to release some brand new figures this time around that we haven't released in previous forecasts. We're going to have a number for gaming advertising. We're going to have numbers for travel services advertising and financial services advertising, which is really a testament to you guys and how much work the whole team has been doing to actually make this happen, and our contributors around the world. So, yeah, I'm really looking forward to spotlighting those pieces for the first time, and telling a more, I don't know, nuanced and layered story about what's happening with global advertising. All right. Well, thanks for listening this week to the Media Intelligence Podcast. Don't forget to subscribe. And if you have any questions for the show, you can email us at business.intelligence@wpmedia.com. The Media Intelligence Podcast from WPP Media is meant for informational and entertainment purposes only and should not be considered financial advice.